Today, August 12, 2025, marks the beginning of the most aggressive trade war in modern history. The United States just implemented 55% tariffs on Chinese goods, the highest trade barriers since the 1930s Great Depression. This isn't just about trade anymore. This is economic warfare that will reshape the global economy and affect every person watching this video. If you want to understand what this means for your wallet, your job, and the future of the global economy, stay with me for the next 12 minutes. Introduction and context. Let's be clear about what just happened. The Trump administration's 55% tariff on Chinese imports is now in effect. This means that Chinese products entering the United States face a tax that's more than half their original value. To put this in perspective, if a Chinese-made smartphone costs $1,000, American importers now pay an additional $550 in tariffs, making the final cost $1,550. This applies across thousands of product categories. This escalation represents the complete breakdown of the world's two largest economies' trade relationship. We're looking at economic decoupling on a scale never seen in the modern global economy. Today's analysis covers four critical areas. First, the immediate facts about these new tariffs and what products they affect. Second, the economic consequences for both countries and the global economy. Third, China's inevitable retaliation and what that looks like. Fourth, my critical analysis of why this trade war represents a fundamental miscalculation that will damage American economic interests. This affects everyone: higher prices, supply chain chaos, job losses, and potential global recession. Pay attention. Section 1. The tariff breakdown: what's actually happening. Let's break down exactly what these 55% tariffs mean and what they cover. The tariffs apply to approximately $400 billion worth of Chinese imports annually. This includes consumer electronics, clothing, toys, furniture, automotive parts, industrial machinery, and technology components. Essentially, if you've bought something manufactured in China in the past year, it's now 55% more expensive. Here's the immediate impact on prices. iPhones assembled in China will cost $200,300 more. Chinese-made clothing will see 50% plus price increases. Furniture, appliances, and household goods face massive price hikes. Construction materials and industrial components become prohibitively expensive for American businesses. The timing is calculated for maximum economic pressure. August represents peak importing season as retailers prepare for back-to-school and holiday shopping. American companies are forced to choose between absorbing massive cost increases or passing them to consumers during the most price-sensitive shopping period. Small and medium businesses face the worst impact. Large corporations like Apple or Walmart can negotiate alternative suppliers or absorb short-term costs. Small businesses importing Chinese products have no alternatives and face immediate bankruptcy from inventory they can't sell at competitive prices. The tariff structure targets China's key export sectors: technology, manufacturing, and consumer goods. This represents an attempt to force American companies to relocate supply chains out of China entirely. American companies have had months to prepare, but supply chain diversification takes years, not months. Most businesses are caught unprepared, facing immediate cost explosions with no alternative suppliers ready. The economic reality is brutal. American consumers will pay these tariffs through higher prices. Despite political rhetoric about China paying tariffs, basic economics shows that import taxes are always passed to domestic consumers. Section 2. Economic consequences: the real costs. The economic consequences of these tariffs extend far beyond higher prices at stores. For American consumers, we're looking at an effective tax increase of $2,000 to $3,000 annually for middle-class families. Everything from smartphones to children's toys to household appliances costs significantly more. This disproportionately hurts lower-income families who spend higher percentages of income on goods rather than services. American businesses face supply chain chaos. Companies that built operations around Chinese suppliers over decades cannot quickly relocate production. Alternative suppliers in Vietnam, Mexico, or other countries lack the capacity and infrastructure to replace Chinese manufacturing immediately. Job losses in import-dependent industries are accelerating. American companies that rely on Chinese components for manufacturing face cost increases that make their products uncompetitive globally. Retailers, logistics companies, and port operations see immediate revenue declines. The inflation impact compounds existing economic pressures. Adding 55% costs to imported goods feeds directly into consumer price inflation, forcing the Federal Reserve to maintain high interest rates longer, slowing economic growth and increasing unemployment. Regional economic impacts vary dramatically. States with major ports like California, New York, and Texas face immediate job losses in logistics and warehousing. Manufacturing states that depend on Chinese components see factory closures. Agricultural states lose Chinese markets for exports due to retaliation. Small business bankruptcies are accelerating. Companies that imported Chinese products face inventory they cannot sell profitably. New inventory costs make their business models unsustainable. Access to affordable products that enabled many small businesses disappears overnight. The global competitiveness of American industry declines. When American manufacturers pay 55% more for components and materials, their products become uncompetitive in global markets compared to European or Asian competitors who maintain access to Chinese suppliers. Financial markets reflect the economic disruption. Stock prices for import-dependent companies fall sharply. Retail chains, technology companies, and manufacturers face investor sell-offs based on margin compression and revenue declines. Section 3. China's retaliation strategy. China's retaliation is already underway and will escalate rapidly. China has imposed mirror tariffs on American agricultural exports, hitting farmers in key Republican states. Soybeans, corn, wheat, and pork face 50% plus tariffs when entering China, making American agricultural products uncompetitive in China's massive market. Technology restrictions represent China's most powerful weapon. China controls critical materials for semiconductor manufacturing, electric vehicle batteries, and renewable energy systems. Chinese restrictions on rare earth exports and lithium processing could cripple American technology and green energy industries. Financial warfare escalates beyond trade. China holds over $1 trillion in U.S. Treasury bonds and can manipulate currency exchange rates to offset tariff impacts. Chinese yuan devaluation makes Chinese exports cheaper, partially negating tariff effects while destabilizing global currency markets. Supply chain weaponization targets American companies still operating in China. American businesses with Chinese operations face regulatory harassment, tax investigations, and operational restrictions. Companies like Tesla, Apple, and Boeing with significant Chinese revenue streams face direct government pressure. Alternative trade partnerships expand Chinese influence. China accelerates trade agreements with European Union, Southeast Asian nations, and Latin American countries, creating economic blocs that exclude American participation. American companies lose access to growing global markets. Chinese domestic market protection intensifies. China prioritizes domestic suppliers over remaining American companies, reducing market share for American businesses that previously dominated Chinese markets. This represents permanent revenue losses for major American corporations. The retaliation timing is strategically calculated. China escalates pressure during American election cycles and economic vulnerability periods, maximizing political pressure on American leadership to reverse tariff policies. Most critically, China can sustain economic warfare longer than America. Chinese state-controlled economy can absorb short-term losses while American private companies face immediate bankruptcy from unsustainable cost increases. Section 4. Critical analysis: why this strategy will backfire. This trade war represents one of the most catastrophic economic policy failures in American history, and I'll explain exactly why. The fundamental economic logic is flawed. Tariffs are taxes on American consumers, not Chinese producers. Every economic analysis shows that American families pay these costs through higher prices. This trade war is effectively a massive tax increase on working-class Americans disguised as economic nationalism. The timing creates maximum economic damage. Implementing 55% tariffs during inflationary pressures compounds cost of living increases that hurt American families most. This trade war accelerates inflation when American households are already struggling with high prices. Alternative supplier capacity doesn't exist. Countries like Vietnam, Mexico, and India lack the manufacturing infrastructure to replace Chinese production immediately. Building alternative supply chains takes 5–10 years, not months. American businesses face years of higher costs with no relief. China's economic resilience exceeds American assumptions. China's domestic market of 1.4 billion consumers provides alternative demand for Chinese products. Chinese companies can survive American market losses better than American companies can survive Chinese supply chain disruption. Global economic leadership shifts to China. While America pursues economic isolation through tariffs, China expands trade relationships with Europe, Asia, and Latin America. American companies lose access to growing global markets while Chinese influence expands. The technological competition backfires. Tariffs on Chinese technology components make American technology companies less competitive globally. European and Asian competitors gain market share while American companies struggle with higher production costs. Agricultural sector devastation is permanent. Chinese agricultural imports can be sourced from Brazil, Argentina, and other countries. Once American farmers lose Chinese market share, rebuilding those relationships takes decades. This trade war permanently damages American agricultural exports. Small business destruction contradicts stated policy goals. The trade war supposedly protects American workers and businesses, but small businesses face immediate bankruptcy while large corporations can absorb costs or relocate operations. This policy destroys the economic base it claims to protect. Political sustainability is questionable. As prices increase and businesses fail, public support for trade war policies will collapse. Political leaders will face electoral consequences for policies that directly increase costs for American families. Historical precedent proves failure. The Smoot-Hawley tariffs of 1930 deepened the Great Depression and demonstrated that trade wars reduce economic growth for all participants. This trade war repeats historical mistakes with predictable results. The strategic objective is impossible to achieve. Complete economic decoupling from China would cost American consumers trillions of dollars and decades of economic disruption. The costs exceed any possible benefits from reduced Chinese economic influence. Conclusion and implications. The 55% tariffs implemented today represent the beginning of economic warfare that will damage American economic interests for decades. This policy prioritizes political symbolism over economic reality. American families will pay higher prices, American businesses will lose competitiveness, and American global economic leadership will decline. The winners are clear. Chinese competitors who gain market share as American companies struggle with higher costs, and other countries that benefit from reduced American economic influence globally. The losers are American consumers, workers, and businesses who bear the costs of this economic nationalism while receiving none of the promised benefits. This trade war will end eventually, but the economic damage will be permanent. Supply chains, trade relationships and global market positions lost during this period cannot be quickly recovered. The most tragic aspect is that this economic warfare hurts the American workers and families it claims to protect while strengthening the Chinese economic position it seeks to weaken. Subscribe for continued coverage of this developing economic crisis. The coming months will demonstrate the full costs of trade war policies on American economic prosperity. The future of American economic leadership depends on understanding the real costs of economic nationalism versus global economic integration. Thanks for watching.